Welcome. Today we're diving into how I'd invest £10,000 in 2026 step by step. Whether you're new to investing or looking to refine your strategy, this guide will walk you through my thought process from understanding your goals to picking the right assets. Let's start by setting the stage. Why is it important to plan your investments carefully, and what should you consider before putting your money to work? We'll cover risk tolerance, time horizon, and the importance of diversification. By the end, you'll have a clear roadmap for making your money grow in 2026. For investing a single pound, it's crucial to define your financial goals. Are you saving for a house, planning for retirement, or building wealth for the long term? Your objectives will shape every decision you make. For instance, short-term goals may require safer, more liquid investments, while long-term goals can tolerate more risk for potentially higher returns. Take a moment to write down your goals and consider your timeline. This clarity will help you stay focused and avoid emotional decisions when markets fluctuate. Next, let's talk about risk tolerance. Everyone has a different comfort level when it comes to investing. Some people can handle big swings in their portfolio while others prefer stability. Assessing your risk tolerance helps you choose investments that won't keep you up at night. Think about how you've reacted to past market downturns, your financial situation, and your investment experience. This self-awareness will guide your asset allocation and help you stick to your plan, even during volatile times. Diversification is a key principle in investing. By spreading your £10,000 across different asset classes, like stocks, bonds, and real estate, you reduce the impact of any single investment performing poorly. Diversification doesn't guarantee profits, but it does help manage risk. In 2026, with markets evolving and new opportunities emerging, a diversified approach is more important than ever. We'll explore how to allocate your funds across various assets to balance growth and safety. Let's break down the main asset classes you can invest in: equities, stocks, fixed income bonds, real estate, and alternatives like commodities or cryptocurrencies. Each has its own risk and return profile. Stocks offer growth but can be volatile. Bonds provide stability and income. Real estate can hedge against inflation, while alternatives add diversification. Understanding these options will help you decide how to allocate your £10,000 for your unique goals and risk tolerance. Stocks are often the engine of growth in a portfolio. For a long-term investor in 2026, allocating a significant portion, say 50%, to equities can help your money grow. Consider a mix of global and domestic stocks and look for low-cost index funds or ETFs to keep fees down. Remember, stocks can be volatile, so only invest what you're comfortable seeing fluctuate in value. Over time, the stock market has historically delivered strong returns for patient investors. Bonds play a stabilizing role in your portfolio. They tend to be less volatile than stocks and can provide steady income. In 2026, interest rates and inflation will influence bond returns, so consider a mix of government and corporate bonds. Allocating around 20% of your portfolio to bonds can help cushion against stock market swings and provide peace of mind during uncertain times. Real estate is another way to diversify your investments. You don't need to buy property directly. Real estate investment trusts, REITs, let you invest in property markets with smaller amounts. In 2026, REITs can offer income and potential growth, plus they often move differently than stocks and bonds. Allocating 15% to real estate can help protect your portfolio from inflation and add another layer of diversification. Alternative investments like commodities or cryptocurrencies can add extra diversification. These assets often behave differently from stocks and bonds. In 2026, you might allocate 5–10% of your portfolio to alternatives depending on your risk tolerance. Remember, these investments can be volatile and speculative, so keep your allocations small and do your research before diving in. For investing, make sure you have an emergency fund. This is cash set aside for unexpected expenses like medical bills or job loss. Ideally, you should have 3 to 6 months worth of living expenses saved in a safe, accessible account. This financial cushion lets you invest with confidence, knowing you won't need to sell investments in a downturn to cover emergencies. Automation is a powerful tool for investors. By setting up automatic transfers into your investment accounts, you ensure consistent contributions and avoid the temptation to time the market. In 2026, many platforms offer automated investing, making it easier than ever to stay disciplined. Automation also helps you benefit from dollar-cost averaging, smoothing out the impact of market ups and downs. Selecting the right investment platform is crucial. Look for low fees, a wide range of investment options, and user-friendly tools. In 2026, digital platforms and robo-advisors make investing accessible to everyone. Compare features, check for hidden costs, and make sure the platform aligns with your needs and goals. A good platform can make managing your £10,000 investment seamless and efficient. Investment fees can eat into your returns over time. Always check the expense ratios of funds, trading commissions, and any platform charges. Even small differences in fees can add up over the years. In 2026, competition among platforms should keep costs low, but it's still important to be vigilant. Prioritize low-cost index funds and ETFs to maximize your long-term growth. Taxes can have a big impact on your investment returns. Make use of tax-advantaged accounts like ISAs or pensions, which allow your money to grow tax-free or tax-deferred. In 2026, tax rules may change, so stay informed and take advantage of any available benefits. Tax-efficient investing helps you keep more of your hard-earned gains. Investing isn't a set-it-and-forget-it process. Regularly review your portfolio to ensure it still matches your goals and risk tolerance. Over time, some investments may grow faster than others, shifting your allocation. Rebalancing, selling some assets and buying others brings your portfolio back in line. In 2026, set a schedule to review your investments at least once a year. Investment world is always changing. Stay informed about market trends, economic news, and regulatory updates. In 2026, technology makes it easy to access information, but be careful not to get overwhelmed by noise. Focus on reliable sources and avoid making impulsive decisions based on headlines. Staying informed helps you make better choices and adapt to new opportunities. Emotions can be an investor's worst enemy. Fear and greed often lead to poor decisions like panic selling during downturns or chasing hot stocks. In 2026, markets will still have ups and downs, but sticking to your plan and focusing on your long-term goals can help you avoid emotional pitfalls. Remember, investing is a marathon, not a sprint. Every investor makes mistakes. The key is to learn from them and improve your strategy over time. Maybe you invested too aggressively or missed an opportunity by being too cautious. Reflect on your past experiences, adjust your approach, and don't be afraid to seek advice or education. In 2026, continuous learning will help you become a more confident and successful investor. Compounding is one of the most powerful forces in investing. When your investments earn returns and those returns generate their own returns, your wealth can grow exponentially over time. The earlier you start, the more you benefit from compounding. In 2026, make sure your £10,000 is working for you by staying invested and letting time do its magic. Don't forget that investing in yourself can offer the highest returns. Use part of your £10,000 to learn new skills, take courses, or start a side business. In 2026, the job market and economy will continue to evolve, and personal development can open doors to new opportunities. Lifelong learning is an investment that pays dividends throughout your life. More investors are considering the impact of their money. Ethical and sustainable investing means choosing companies and funds that align with your values, such as environmental responsibility or social good. In 2026, there are more options than ever for sustainable investments. Allocating part of your portfolio to these funds can help you make a positive difference while pursuing financial returns. Investing globally can reduce risk and tap into growth opportunities around the world. In 2026, emerging markets and international companies may offer strong returns. Consider allocating part of your £10,000 to global funds or ETFs. This approach helps you avoid overexposure to any single country or economy, making your portfolio more resilient. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility and removes the pressure of trying to time the market. In 2026, setting up monthly or quarterly investments can help you stay consistent and build wealth over time. There are common mistakes that trip up many investors: chasing hot stocks, ignoring fees, or failing to diversify. In 2026, information overload and market hype can make these pitfalls even more tempting. Stay disciplined, stick to your plan, and remember the basics: diversify, keep costs low, and focus on your long-term goals. If you're unsure about your investment choices, consider seeking professional advice. Financial advisors can help tailor a plan to your needs and keep you on track. In 2026, there are more options than ever, from traditional advisors to digital platforms. Choose someone who is transparent about fees and puts your interests first. Patience is a virtue in investing. Markets will have ups and downs, but staying invested and giving your money time to grow is key. In 2026, resist the urge to make frequent changes based on short-term news. Trust your plan, review it regularly, and let compounding work in your favor. Track your investment progress over time. Use tools and apps to monitor your portfolio's performance and make sure you're on track to meet your goals. In 2026, technology makes it easier than ever to stay organized and informed. Regular check-ins help you celebrate milestones and make adjustments as needed. Life changes, and so should your investment plan. Major events like marriage, a new job, or starting a family can shift your goals and risk tolerance. In 2026, be ready to adapt your strategy as your circumstances evolve. Flexibility ensures your investments continue to serve your needs. Don't forget to celebrate your investment successes, big or small. Reaching a savings milestone, earning a good return, or simply sticking to your plan are all achievements worth recognizing. In 2026, take time to appreciate your progress and use it as motivation to keep building your financial future. Investing £10,000 in 2026 is all about planning, discipline, and adaptability. By setting clear goals, diversifying your portfolio, and staying informed, you can make your money work for you. Remember, the journey is just as important as the destination. Stay patient, keep learning, and enjoy the process of building your wealth. Here's to your financial success in 2026 and beyond.